Do you think that finally, as we approach February the 10th for the Chinese New Year, the dragon spirit might be rekindled?
Well, I'm not sure about the February 10th being the date, but certainly over the course of this year, we remain positive or constructive on the overall China market. And maybe just lay out how we think about it. So first of all, from a global macro perspective, we think US interest rates will drop, and particularly the 10-year Treasury rates is what we're watching for. And historically, there's been a pretty high negative correlation between declining US Treasury rates and MSCI China market. And if we're right that US Treasury rates will drop 1.1 percentage point next year or this year, MSCI China PE multiple should re-rate up by 10%. And we also don't expect US S&P. Yeah, sorry. Yeah. Yeah.
Oh no, sorry, I didn't mean to interrupt there.
A significant decline. Yeah. And we also don't expect S&P to decline significantly, actually up single digit, despite a mild slowdown. So the global macro environment for the China MSCI China market remains quite positive. And then we look at the China economy this year. Yeah.
Yeah, how much of the Chinese market's fortunes are tied to that global macro environment you just elucidated, James? And how much is what's happening with regards to policy in China and other sectors which have been very much an overhang on the market, such as the property sector?
Yeah, so definitely there's uncertainties around the property sector and also the domestic policies. So if we turn to the domestic environment for China, first of all, the last year has been a very difficult year. A lot of it is to do with PPI and CPI being negative. So while real GDP, we expect 2023 to be over 5%, 5.2%, but nominal GDP is actually much lower because of these deflators at 4.6%. For this year, we expect nominal GDP to actually pick up because of CPI and PPI normalizing. So that acceleration in nominal GDP should be positive for revenue growth for the overall market. And historically, also what we find is that there's been a pretty high correlation between PPI and company revenue growth. And PPI last year has also been hampered because of there's been an excess inventory build-up due to the COVID lockdowns. And that inventory digestion looks like it is being done, and we're seeing a bit more life coming back in inventory rebuilding in some of the industries, and that should also result in an acceleration in revenue. And then on the margin side, we think that margin, if you look at net profit margin for the Chinese companies, it's also at a historical low. So with a bit of revenue growth accelerating, we should see margin expansion coming through, and also CPI remaining above PPI should also help with the margin improvement. So overall this year, we expect 10% EPS growth for MSCI China, which is looking pretty good versus some of the other major equity markets. And that was what we think makes the China market remaining quite attractive for overseas investors.
It does remain quite attractive and has been so for the last many quarters, given low valuations, James. But where's the money?
I think the money is there, but they're just ready to be deployed. So if you look at foreign investor positionings, they're already below October trough last year, or which is one of the lowest level it's ever been. And I think if you speak to domestic onshore investors, sentiment is also quite downbeat. But if you look at the amount of retail deposits in China that's being built up, it's been very significant. So consumers, fund managers overall have been very cautious investing into the equity market, partly because the regulatory uncertainties which we've experienced in the last 2 years, but also on the property downturn. As we've seen yesterday, we saw the policy bank injection. That could be a signal that we're seeing real money coming through from the government to revive the property sector. And I think that over time, if we see the property market stabilizing, that could also revive sentiment from both onshore and offshore investors in the China market.
Is that enough? Because you prefer the Chinese internet space. And just before we closed out 23, there was that big announcement, that big crackdown on gaming regulation, right? Just when the message that went out was that on the regulatory front, things have stabilized. And that just jolted investors once again. Yeah.
I'd say definitely in the short term, it'll be difficult for investors to come back to the internet sector until they see clarity on exactly what comes out of that online gaming regulation. So definitely in the short term, that could deter investors. But I think over the course of the next 12 months, I think the government is definitely turning pro-growth, and we've seen the news that they've significantly released the number of new gaming being improved, and also potentially removed the official that was in charge of the gaming regulation. So we're still positive on the overall internet sector, but I think it needs a bit of time to proof up our theory.